Welcome to the financial district, where everyone is looking for the ultimate investment strategy. Meet Ethan, who just received his monthly rent notification and feels like a real estate genius. He drives by his rental property, thinking he has unlocked the secret to passive income.
Find a place that's close to the city and the beach.
He visualizes his mortgage payment chipping away at the principal, building equity automatically. During tax season, he looks at deductions, convinced real estate is a tax shelter. In the suburbs, housing prices are rising, making property look like a foolproof gold mine. Ryan enthusiastically claims that his house practically pays for itself. Emma adjusts her glasses and asks the critical question. Does it really? Meanwhile, Oliver sits in a coffee shop, watching his brokerage account steadily compound. He calmly observes numbers growing on a digital screen with total peace of mind. Today, we explore the psychological traps of productive versus demanding investments. At year 3, Ethan reviews his real numbers, comparing rent collected against mortgage payments. Suddenly, he faces property taxes, insurance bills, and a broken water heater. A roof leak and a vacant month hit his cash flow hard. He answers late night and lunch break emergency repair calls, completely exhausted. He recalculates his true net cash flow over 3 years and realizes it has shrunk significantly. Oliver enjoys his coffee free of emergency calls while his index fund quietly grows. Ethan looks at property appreciation and equity growth powered by leverage. Let's dive into monthly rent checks versus true ownership reality. Ethan stares at a vacant rental property during a vacancy month while bills keep piling up. Ryan frowns, confused about what true passive income actually means. Emma explains with a laugh that even passive income requires a manager. Ethan learns to reserve maintenance funds based on property percentages. He deals with a broken air conditioner on a hot summer day and a furious tenant. He reviews capital expenditures like failing roofs and water heaters. He faces a costly roof replacement invoice ranging from $8,000 to $15,000. Maintenance fixes today's problems, while capital expenditures replace tomorrow's components. Ryan scratches his head, asking if experienced investors actually expect these massive bills. Emma nods, explaining that smart investors save for repairs long before they happen. Ethan manages the property himself, handling late-night calls and weekend showings. He calculates property management fees at 8 to 10% of monthly rent. He deals with legal fees and the stress of a difficult tenant refusing to leave. He reviews his original $470 calculation and realizes it missed crucial costs. By year 5, Ethan thinks like a seasoned landlord, welcoming his third tenant. He faces a major roof replacement costing roughly $8,500. A plumbing emergency floods part of the house, costing $1,400. He notices rising rent is completely matched by increasing taxes and insurance. Ryan looks confused, saying he thought rent always goes up. Emma points out that expenses go up too, and expenses must grow slower than income. Emma recalculates Ethan's actual cash-on-cash return, revealing it hovers around 3 to 5%. Oliver sits calmly in his coffee shop as automatic investments compound over 7 years. His portfolio grows between $135,000 and $150,000 with zero effort. Compound growth accelerates and bends upward over time. A side-by-side comparison contrasts Ethan's active repairs with Oliver's passive compounding. Ethan inspects his rental property at year 10, valued between $335,000 and $350,000. He reviews 10 years of out-of-pocket costs, including interest, taxes, insurance, and repairs. Ryan claims a win, while Emma reminds him that profitable doesn't mean effortless. Oliver reviews a 10-year statement showing growth between $165,000 and $180,000. A split screen compares Ethan's single zip code risk against Oliver's diversified index fund. Ethan stands outside his property at year 20, valued near $500,000, with a nearly paid-off mortgage. Ryan smiles proudly about real estate wins, while Emma calmly shakes her head. Oliver looks at his 20-year index fund balance between $420,000 and $460,000. Ethan and Oliver stand side by side at year 20, reaching nearly identical net worth destinations. Oliver simulates increasing his monthly investment,
and watch your
scaling
money
through
scale
capital
effortlessly,
rather than workload. A market crash chart illustrates historical drops, showing the resilience of long-term holding. Ethan demonstrates real estate leverage, depreciation, and tax deductions unavailable in stocks. Ethan successfully practices house hacking by living in one unit and renting the rest. Ethan and Oliver reflect on how neither path is easy, just difficult in different ways. The final takeaway? The only investment calculation that
includes all
matters
the
is the one
hours,
including
costs,
every
and
cost,
risks.
hour,
Thanks
and
for
risk.
breaking that